All right, welcome to OK Computer. I'm Dan Nathan, joined again by Guy Adami. Guy, how are you?
How are you? I'm well. I'm well. Always a joy to join you on the OK Computer. One of my favorite albums of all time,
Oh,
as you know.
geez, you're gonna do it again. Radiohead album. It's a fabulous album, but we're not going there right now, Guy. You and I got a lot to talk about. Really quickly, we just want to hit a few names, hit some of the price action since we talked last week. I think we went over a lot of sectors. We went over a lot of things that we think might happen under a new administration as they think about tech, primarily in the public markets. But stick around for my conversation after this with Imran Khan. He's an old friend of mine. He is the CIO and founder of Proem Asset Management. He's a former COO at Snap. He was a massive investment banker. He took Alibaba public back, I want to say at least 10 years ago or so. So Imran and I, we go through his process, how he thinks about different secular shifts in tech, and a whole host of other things. So stick around for that conversation. All right, Guy. Last week, like we said, we went through a bunch of these names. We talked about the potential for regulatory, good and bad. So let's talk a little bit about what we're seeing right now. We've seen the Mag 7, other than Tesla, kind of go sideways a little bit, which makes some sense. They were the leaders for most of the year, most of the last year and a half. But let's first hit this move in Tesla. At its highs yesterday, that would have been Monday, it was up 40% in just like a week and a half, right? So what's going on here? We know Elon was a big backer of President Trump. He made a very binary bet on this. He's been rumored to have some sort of maybe role in the new administration, but it really is about, okay, do the regulators kind of step back from his full self-driving dreams, his autonomous dreams? There's a whole host of other things. Maybe it's a way to just play the Elon kind of ecosystem, whether it's SpaceX or LetterX, that sort of thing. Thoughts here, because today, as we're talking, stock's down 6%. Seems like a rounding error when you consider how much the stock rallied over the last week or so.
Well, I mean, to your point, he made a very large bet, and that bet, through the lens of Tesla stock, paid off in a significant way. Now, the question you have to ask yourself is, are any fundamentals behind that, or is this just sort of people that were not in the name getting in the name, sort of forced to get in the name? Is it just sort of this last bastion, this last ditch effort late in the year to sort of get, I don't know, exposure to the name in your portfolios? There's a lot going on here. Asset prop managers of money need to have certain things on their books by year end. If they don't, they have to answer a lot of questions. And as the price action suggests in Tesla, that's going to be one of those names at the end of the year that people clearly ask about. That's part of it. But the fundamentals to me have not really changed all that much. I think the wild card in all of this, Dan, and we discussed it, is if given some sort of cabinet post or some tangential cabinet post, whatever that looks like in this new administration, will that force Elon Musk to leave his post at Tesla? Now, as I said, I think last week on your show, 6, 7, 8 years ago, that probably would have been not catastrophic to the stock, but the stock would have sold off. I'm not sure in today's environment it wouldn't be a net positive for the stock. So I think that's part of it as well, in my opinion.
Yeah, and then we got to talk about this rotation out of semis over the last few days into software. The IGV, the ETF that tracks the software, it's just gone parabolic. It was at an all-time high. It went up about 11% in a straight line. It's up today, a day that the SMH, the ETF that tracks the semiconductor index, is down 1.25% or so. And some of the biggest names in there are not acting particularly well. So when I think about what's going on in enterprise software, Guy, they were really left for dead as folks are just piling into this generative AI trade. But look at the move in Salesforce that we've seen over the last week. The move in Adobe, which is still down on the year. Today it's up 4%. This is Tuesday, 2 o'clock or so. Some of those names have gotten back on their horse. I think what it is, I think people are taking profits in a trade that has worked really well. I think, we have NVIDIA earnings next Wednesday on November 20th. And as we see some of these semi names give some stuff back, I think it makes sense to kind of move into some software stuff. The only thing I'll just say is if you look at the biggest software name, Microsoft, it sorely lags the QQQ, the NASDAQ 100. It's only up about 12.5% of the year. So I worry a little bit about the generative AI trade. And if that's the reason why money is going to enterprise and out of semis in the Mag 7 or the Mag 6, if you will, then I don't know if the QQQ or the NASDAQ rally is on such great footing, Guy.
Liz Young Thomas from SoFi actually started talking about a potential for the rotation into software a while ago, and that's been playing out in a major way. I think you're right to point it out. And then Salesforce obviously is not the biggest name, but one of the names that everybody knows. If you look at CRM, and it's fascinating to me, this was a stock that made its first all-time high about 315 back, like many stocks, in November of 2021. We traded up there again, Dan, this spring in March, and then had a pretty precipitous sell off. And it looked like, again, on the back of AI, people were going to flee from software and then we get into AI. And it was manifesting itself in some of the sell offs in these names. Well, as that is sort of reversed a little bit, you see what's happening. And today, this is now Tuesday, the 12th, you're seeing Salesforce make a new all time high, almost at $350 or so dollars. Of course, the problem is by doing so, it's gotten itself a little bit expensive on valuation. So I understand what's going on. It does make sense. But right now, I think what's happening is people are getting out of one expensive sector and making the next sector, software, not as expensive, but expensive as well, given their history.
Yeah, and I just got to talk about one other name here before we get to Chinese internet stocks, because I think that's a really interesting scenario. So here's Shopify. Okay, this is a company that has a big market cap now, and it's not a company that we talk a whole heck of a lot, right? This engine that powers a lot of e-commerce, $144 billion market cap right now. The stock is up 24% today on a beat and raise. Just think about that, guy. It just tells you how folks are just willing to chase things right there. The stock has gone from 80 to about 111, okay, in just 5 trading days. Just think about that. Like, how do you explain that sort of price action in a single name off a single report?
No, there's really no explanation for it other than bad positioning by people. And again, this sort of race to get into names that, remember Shopify, and I know you know this was everybody's darling from 2020 into 2021. I mean, this was a stock that probably went from $30 a share, probably close, if I had to guess, to $175 a share over the course of about a year and a half. I mean, if you look at the peak market cap of this thing, it was probably $250 billion company at one point. Had the huge sell off like everything else. And now I think it's people saying, well, wait a second. I remember when Shopify was everybody's darling. I think some of that is going on now. But in terms of the magnitude of the move, doesn't make a lot of sense to me.
All right, last thing, Chinese internet stocks. Okay, when we saw the first bout of stimulus, I think it was about mid-September, guy, we saw an epic rally. We saw folks like, David Tepper of Appaloosa come on CNBC and said he's buying everything in China, with two fists, right? And anything that wasn't bolted down. Let's just use Alibaba as a sort of proxy for these names, okay? Alibaba rallied 40% in about 10 trading days. Since then, it has come in about 20%. It's nearly filled in a gap. The chart is fascinating because the high in May was about $90. It got back to that $90. That's where it originally gapped from. It went from 190 to about 117, 118. And here we are right now back at $92 or so. I mean, guy, how much would tariffs? I mean, like that's the thing. I'm hard pressed to think, you know what I mean, that some sort of tariff war is going to be so bad for Chinese consumers. I mean, like, yeah, I get it. But when you think about how depressed their economy is right now and the fact that investors move so hard into these names, round tripping that whole move, it starts to look a little interesting to me, guy.
Well, I mean, I'll say again, if you go back to May of this year, Alibaba traded up to about $90 or so and
Mhm.
then had a huge sell off into the summer. I think it got down to almost $70. So this move back down to 90 gets you right back to previous resistance. So past resistance becomes support. But to answer your question, I don't think necessarily what's going to happen in terms of tariffs is going to necessarily move the needle on some of these names, specifically in Alibaba. And I think there's another round coming. Now, David Tepper's announcement in terms of buy everything, it probably timing wise wasn't particularly good given what's happened in the aftermath. But I think he's going to wind up being right. It's just going to take a little bit of time. But you've given up, to your point, the entirety of that move.
Yeah, and last thing I'll just say about this, you talked about a darling during COVID. I mean, from its highs in 21 to its lows in late 22, the stock sold off 80%. I mean, when you think about that, that looks like some stuff on a 5-year chart that we haven't seen since the top of the NASDAQ in the year 2000 into the lows in like kind of late '02 or so. So again, I find these China internet names kind of interesting because they were so in favor about a month ago. They're so out of favor now. And maybe that presents an opportunity from the long side. All right, Guy Adami, I just want to hit a couple of these kind of big movers over the last week or so, because I think this volatility is going to present a lot of opportunities in the public markets. I think next week, baby, NVIDIA, Wednesday afternoon, that might be the main event here. So we're going to check in again on Tuesday or Wednesday prior to the NVIDIA results. But in the meantime, check out my conversation with Imran Khan. We go deep in his process. We go deep into kind of trading and portfolio management and risk management. I think you guys are going to enjoy it a great deal. Guy, thanks for being here. We'll see y'all next week. All right, welcome to OK Computer. I'm Dan Nathan. I am joined by a good friend of mine, Imran Khan. He is the founder and CEO of Proem Asset Management down in Dallas, the Big D. Imran, welcome to the pod.
Thank you for having me.
You and I have sat in these very seats and we've talked about your fund. We've talked about ideas, but now we just turned the mics and the cameras on. So I'm really excited for our listener, our audience to get to know you a little bit.
Thanks for having me. It's an honor.
Yeah, so we're going to talk about, I want to start with your background because it's really interesting. You took a path to fund management, which I think a lot of folks would actually love to have the career that you had. And I think at every, twist and turn, you probably went to a place that you didn't think you were going to be going, especially the way you started out. So I want to talk about all of that. I want to talk about the markets, obviously, where you guys are invested. What are some of the themes that you're most interested in? We got to talk about what looks like it's going to be a new regulatory regime and how that affects a lot of areas in the markets. What the IPO calendar looks like. It's been dead for a couple of years. And then I want to talk about VC a little bit and some of your thoughts. I know that's not an area in the private markets that you're focused on, but I know you look very closely at what's coming down the pike. You talk to a lot of VCs, you talk to a lot of founders in the private markets, and maybe how that informs how you invest in the public markets.
Sure.
Makes sense?
That
All
makes
right.
sense.
Let's start a little bit with your background, because you started out and as an equity research analyst, then you moved into investment banking. You were actually the lead on one of the biggest tech deals, I think, ever, if that makes some sense. You moved onto the operating side. You were at Snap pre-IPO, and now you're a fund manager. So let's start a little bit about how you got into finance, equity research, how you moved in investment banking, because I think a lot of our listeners are going to find that very interesting.
Fascinating story.
Yeah.
As you know, I grew up in Bangladesh.
Yeah.
I never knew what Wall Street is. So I showed up for college, and I took a finance class, and I really, really loved it. Like literally fall in love with finance, and so I start taking more finance classes, more economics classes, switch my major to economics and finance. And then in my sophomore year, one of my friends, who is older friends, who got a summer internship at SG Cowen. So now I went to University of Denver. In late 90s, no investment bank in Wall Street outside SG Cowen would recruit from University of Denver. And I don't know if even today anybody recruits. They all be like.
Well, by the way,
schools.
it's a very hot school right now, and I know
Because
that
of
because I have college age girls, and I know a lot of their friends were looking at University of Denver. So, but again, there's a lot of regional kind of bias towards going to Wall Street, and,
exactly.
so I totally get that.
Yeah, it was hard too. So I literally cold call, and cold email. Somehow, got a job, a firm called Farm and Sales.
Which is
most
gone.
people
That was actually a really hot boutique in the late 90s for themselves.
It's amazing.
Yeah.
So many firms that I worked don't exist anymore.
Yeah.
So Farm and Sales, and in investment banking analyst program. And then the gentleman who was the CEO of Farm and Sales started a boutique research firm in 2001. And his view was that Wall Street research is tainted. So we should go create a firm that just only focus on research, no investment.
Tainted because of the conflict of interest with investment banking.
Yeah, in 1999, 2000.
Yeah.
And so I went there, and I was an associate covering software. And then in 2001, I went to my boss and said, why don't I cover internet? I'll do my day job. And my boss said, go kill yourself. So I said, fine. So I worked on the weekends and nights, picking up coverage of internet.
All right, I gotta take a step back. So again, a lot of our listeners know we had this crazy period of outperformance. The internet was like the bubble that was being created in the late 90s. Now, when the bubble burst, and again, no one thought that it was burst, that it was over, but a lot of the stocks that you were probably covering in 2001 had been down 80% or so,
it was
or maybe
terrible.
more.
Yeah.
Okay.
So I picked up coverage of Amazon. I think, if my memory serves correctly, $10.
Yeah.
Yahoo and
Yahoo went to $4
yeah,
at its
like
lows.
nobody cared about those stocks.
Yeah.
And so I picked up coverage, and I was lucky. I was working in a boutique shop. In a big firms, they would not let me do it.
Yeah.
So I picked up coverage, and then I looked genius because the stocks all went up.
Yeah.
And in 2004, JP Morgan was looking for a research analyst to cover internet because Google will go public and internet was having a comeback. And they couldn't find a research analyst. So all my clients recommended me. And I was 27 years old. And I got hired at JP Morgan to run their global internet research. So, and then it was a great run. I was, ranked by many clients, and did really well. And people liked me. And I started going to China. And in mid-2000, I met Joe Tsai, who is the chairman of Alibaba, one of the co-founders, and was CFO. So he and I became good friends. And in 2010, he suggested that I go to investment banking. So that's how I ended up going to investment banking the end of 2010, beginning of 2011, as a head of global internet banking at Credit Suisse. And then I helped Joe buy back share from Yahoo, which was an $8.8 billion repurchase. I helped finance the transactions through equity, debt, and convert. We invested $50 million Credit Suisse money, which generated, we bought the stock at $18.50, sold it at $95. And then obviously Credit Suisse was one of the lead banker, and I played a pretty critical role on the Alibaba IPO. So that was a great run. And then end of 14, I think Alibaba went public in September 14th or something like that. Again, I could be dated.
Did you start covering Alibaba from a banking perspective because it was such a big part of Yahoo? Is that how you got to cover Alibaba? Or no?
Yeah. So yes, I was a research analyst. I was not a banker.
Yeah.
Yes. I was genuinely interested in China.
Yeah.
In many ways, at that time, China is the only country who would let me go because I had Bangladeshi passport, which is a terrible passport to travel anywhere. Nobody gives you visa. But China, I would go to China, and I thought, it felt like there's a lot of population, and internet is a volume game.
And Baidu had just gone public in 2005, right?
Yeah. So I started looking at Sohu, Sina, all these names. So Alibaba was one of them, but interest was because of Yahoo investment. And I took a group of investors a couple of times to China. So that's how I developed a great relationship with Chinese companies, which played pretty important role in my banking career. I think we did I forgot the exact number, but 12 or 14 IPOs, something like that, when I was at Credit Suisse in China. And we had a very strong franchise. But so Alibaba went public in September 14th or 19th, something like that. And then a couple of days later, I got an email to meet with Evan, because he was very interested.
Evan Spiegel, the CEO, founder of Snap.
And we met, and we really get along together. And he offered me a job, and I thought he was a really talented, gifted product guy. And I was like, okay, if the product is right, I can figure out how to monetize it. So I end up joining. The company had a very small team. We had in January 2015 we had zero revenue, and 2018 at the end of 2018 when I left, we were doing over $1 billion revenue.
Primarily advertising.
100% advertising.
Yeah.
And I ran all revenue, partnership, M&A, Corp Dev, HR. So it was a great run. So when I left Snap, I was like, okay, what do I do? And I always loved stocks. I was an analyst for a long period of time. I always loved stock, always talking about stock. And few people called me, do you want to go to a different company? I was like, no, if that's the case, I would work for Snap. So I decided to start the fund. So that's how the Proem got started.
Well, it's interesting, a lot of analysts, research analysts, and I've been on the street now since the late 90s, they're kind of risk averse. They like doing the, analytical work. They love getting to know the companies. They love kind of forecasting a little bit, but they don't like taking risk, right? And so, there are a handful of, analysts over the years that I've gotten to know who all they wanted to do, like that was the skill set that they were building towards. And a lot of them are not particularly successful at it. A lot of them used to go to these pod shops, or they'd go to like a SAC or whatever, and the stress is really great, and there's a lot of competition, and you're competing for resources with the investment banks and the like, and access to companies. So it's interesting because you've had this great progression, right, from equity research to investment banking to operating, and it all makes sense that you put all that stuff together, willing to take some risk, and then you become a successful fund manager.
Yeah, I think the fund management. Really, we started the fund because I wanted to build a fund that I wanted to invest. One of my biggest challenge as I looked at, Snap, I've been very blessed, right? Had a great career from research analyst to banking, doing the biggest IPO in tech and second biggest IPO in the world, and the biggest IPO at that time, going to Snap, again, one of the biggest IPO, and build a business from zero revenue in January 2015 to where it became. And Evan was very generous to me. And so I had some financial success. And my choice was, one, what I do with my life. I was still very young because when I left in Snap at the end of 2018, I was only 41 years old. Second, how do I invest my capital? And my biggest issue with a lot of the hedge fund is they underperform the market. And I refuse to pay someone who underperformed the market,
a management fee and a performance fee.
And
You think that's a little aggressive?
Yeah, because the reality is, listen, I think some people are really, really concerned about volatility.
Yeah.
And that's fine. I admire that. But I believe tech is a multi-decade opportunity. If you believe technology is a multi-decade opportunity, and every 15 years something new happened, right? Look at 1960s, it was mainframe computer. Late 70s, it was microcomputer. Mid 90s, it was internet. 2010, it was an app economy. Now we're talking about AI. So every 15, 20 years, something happens, and it brings so many new opportunities. I never understood, why would you want to run a market neutral fund in technology? It makes sense in other parts of the economy, but why would you run? And I believe in tech. And I think, there's so much. I work with some of the best engineers in the world and best entrepreneurs in the companies. I see the long-term opportunity. For me, running a market neutral fund in tech make no sense. So to me, if I want to invest in tech, one of my goal was trying to find that, hey, I don't care. Obviously I care about volatility. I don't want a massive drawdown, but I also want, don't need to over-optimize volatility, but I want to get risk-adjusted better return. And I just couldn't find a fund. So I wanted to start a fund that I wanted to invest. And that's really led to creation of Proem.
Yeah, so let's talk about some of those big shifts that you just mentioned. So again, let's just start in the late 90s, obviously internet. And the idea there, it was to basically change almost every business model that existed, at least in technology for the time being. And then all the ecosystems and the supply chain and that sort of thing, and telecom, right? And so then flash forward, you almost have to have this euphoria and then this kind of trough of disillusionment, the whole drill, right? And then there's opportunities that rise from it. Think about hundreds of companies went out of business, both private and public, right, in the wake of the popping of the internet bubble. And then you have this move into the app economy, which you just mentioned, which is the convergence of mobile and social and cloud, all right? And now here we are, machine learning and AI have led to this, generative AI opportunity. The use cases are not obvious yet. The use cases for the internet, might have been there. They weren't obvious. The use cases for cloud, maybe, and mobile and social were not always obvious. What is obvious to you right now? Obviously, these are trends, that you've been tracking, for 20 plus years or so. Talk to me about what you think the opportunity is and how much bigger it might be other than, as opposed to like the other ones that I just mentioned.
Yeah, so I don't get super excited about technology itself because technology, a cool technology doesn't mean anything. I think fundamentally you have to think about it, what improved productivity? Because when the productivity improves, GDP grows faster. And if GDP grows faster, it creates better economy. So I look at technology, what creates, so microcomputer in late 70s, early 80s, massively improved productivity. If you talk to anybody who was investment banker in 70s or even early 80s versus somebody who talked about 90s, they start using spreadsheet, massive productivity improvement. That's just one example, right? I'm old enough that, when I first driving, I used to have map book, right? Think about it, like how much productivity it improved.
And then you used MapQuest.
MapQuest,
Right? Yeah.
So the internet massively, incredibly improved productivity, and that drove the company's value creation. Same thing, in late 90s, microcomputer and then internet created this productivity.
Right.
Then same thing, apps also create productivity. Not always positive way, but it create productivity, and it also brought a lot of entertainment value. But you can argue companies like Uber, DoorDash, even social media, because people are so, there's a lot of misinformation, but it also, I would argue that, I find Twitter analysis of companies better than 90%, it's my opinion, 90% of sell-side research analysts, because, and you're having an active dialogue, I remember when I was an analyst, early days, I was covering PeopleSoft. I used to go to this 10 different user conference. Now I don't go to any user conference. Right. I find everything, think about my productivity improved so much because I learned so much from these great minds in social media arguing about technology's efficacy, which is so great.
Well, let's take a step back because we get these questions all the time. What is your process? How do you find, ideas? And then how do you kind of test those ideas with other investors? And I think a lot of the answers that we get now is exactly what you talked about. There's just tremendous amount of intelligent, kind of analysis that's free on the internet, whether it's Reddit, whether it's Twitter, and your ability to connect with people. And obviously you have a lot of connectivity with the sell side. How do you develop ideas? Do you start with a sort of macro view and then you start with a micro, view on the company level and meet in the middle? Talk to me a little bit about how you think about creating a portfolio, which is obviously a portfolio of stocks.
Yeah. So the idea generation comes from reading a lot,
about history too, because you were just talking about the 70s and the 80s.
Yeah. I think history repeats itself.
Yeah.
But in general, right, I read a lot of newspapers, blogs, social media, sell-side research, listen to a lot of earnings call, think about the world, what's happening around the world. That's how the idea comes. And then, what I have some check mark that I have created over the years that worked for me, that I think created value, so there's a 30, 40 different check mark, is the revenue growth rate accelerating? Is the gross margins improving? Is the company's a positive CapEx upgrade cycle? Or is the company's now, the CapEx cycle is moderating? I have 30 or 40 different things that I look at, and then if these companies fit into those criteria, that, just the formulas that I developed over the last 2 decades as an analyst, as a banker, as an operator, then based on that, I narrow it down. And then I go to valuation. That okay, is there?
So valuation is one of the later parts of this.
Valuation is because my view is I always laugh at it when people call me up and say this stock is cheap. Anybody who has any finance classes can figure out if a stock is cheap or not based on EBITDA multiple. Yeah. You have to incrementally think about it. Is things are getting incrementally better or things are getting incrementally worse? And I think, stock is a thing that you don't have to be super early on it. You can take your time, and the thing is that also things goes negative, it can have a cascading effect. Sometimes, when you run a business that has a domino effect. When you start doing well, guess what? Everybody wants to do business with you.
Right.
That brings more business. That brings more opportunity. That means great talent come to you. When a company starts doing bad, nobody wants to talk to you.
Right.
Nobody wants to do business with you. You cannot attract people. So there is a domino effect, right? So you have to take that into consideration. And I always believe that success brings new opportunities. Failure reduces your opportunities. So you kind of have to think about those things. So I look at the business, I think, okay, those are the different checkmark that I developed over the years that I think is a good indication for a technology companies, the fortunes is about to change or changing or incrementally things are getting better. once that check mark on that, then I look at valuation to understand, is that priced in or not priced in?
Are you generally looking at valuation relative to its peers or to like a market multiple, that sort of thing?
I look at valuation to its peers is a really, really dumb idea. In my
Really?
opinion.
Okay.
Yeah, because that's a greater fool theory.
Yeah.
That's how people lost money in 2001.
Yeah.
That's how people lost money any kind of bubble.
Right.
And that's how people miss out stock when the market is really, really down, because they look at, okay, something else is cheap, so should be cheap, or something else is more expensive, so this should be more expensive. At the end of the day, every company is unique. I think about the most simplistic way. I think about it is that, okay, if I believe, based on all the research I did, that this company or this house in a good neighborhood, that there is a secular tailwind. Ultimately, if there is no secular tailwind, it's very hard. You're fighting against the current. It's on the right side of the world, history. If that's the case, then look at the business. Then look at all these metrics that I like to look at it. The quality of the management team. I have a very strong biases towards founders.
Yeah. And you also get access. I mean, one of the things we'll talk about the conference, that's a KAHN that I was at about a month ago down in Dallas that you put on is absolutely amazing. And, one of the things is because you've been on the street for so long and you've done all these different jobs, you basically know everyone. And so
I do, but there are a lot of new companies coming out.
Yeah.
I don't know. And some of my best performing stocks, I never met the management team.
Yeah.
I actually fundamentally believe that sometimes meeting people is a bad idea.
Yeah.
Because it biases your opinion.
Yeah.
Because, we all have our biases.
Yeah.
To pick, I think, perfect example, I think a lot of people missed out Tesla because of their personal biases for Elon Musk, and I think a lot of people lost money on Tesla because, buying the stock at the wrong time because of their personal biases on Elon Musk, So I think it's really, really at the end of the day, when you look at the companies, having a good relationship with the management team is a terrible thing.
Well, that's interesting.
I don't like having a good relationship with the management team. I actually never buy companies that I know the management team super well.
Really? Okay,
yeah,
that's
because
interesting.
then it brings personal biases.
Yeah. All right. So back to the process, though. So, so you look at a company, you like the business, you like the secular shifts, that sort of thing. You narrow it down to a handful of different ways to play it, and no shortage of one. I mean, what's beautiful about tech is like you can go look at industrials, you can look at financials, like they're all the same pretty much. You know what I mean? Like they're not like you don't see too much outperformance within some of these groups in retail and the like here. But when you think about tech, like there's just so many opportunities as you get these different shifts. And like, do you look at catalyst? Is that it?
No,
and
I don't really look at catalyst. So what I look at it, so if it's on the right side of the history, right company, then I look at, okay, are things getting incrementally better, or do I think that things will incrementally better based on those check marks that I developed over the years? And then I look at valuation, and I had a simple question, right? I own 30 names at a time, like plus minus, obviously not always 30. I look at, okay, can this company generate 100 basis point return for me?
Right.
That's the question I ask.
Right.
And to generate 100 basis point return, what percentage of book it needs to be, and what kind of volatility it can bring. And am I comfortable with the volatility? So if the stock is super volatile and I have to buy a lot to get 100 basis point return, I would never buy the stock.
Right.
So volatility adjusted basis, in my mind, there's no scientific, that do I feel comfortable that in my overall portfolio, that the amount of volatility will inject, does that give me enough confidence that is it worth taking 100 basis point risk?
Yeah.
And if that's the case, I would buy the stock. And that's why I don't look at the comps. I don't look at anything. I look at it a couple of things. One, do I buy the stock at this price? First question I ask, forget about my portfolio, forget about market, forget about everything. Based on all the things that I learned about the world, about all the check marks and the valuation, do I want to own the stock for next 12 months, 18 months, 24 months?
Is that your time horizon? Usually it's at least a year?
Yeah, at least a year. Yeah.
Okay.
And then if that's the case, do I can I get 100 basis point return on my fund? And then do I feel comfortable with the potential volatility it can bring?
Right.
All these things check mark. Then I look at it again. I never want to own 50 individual stocks. I want to own like around 30. And then I just rank them and buy them. That's kind of my process.
Right.
I just want to buy 30, around 30. Again, it's number changes.
Yeah.
great businesses that can potentially generate 100 basis point return with the volatility that I feel personally comfortable
with. All right, and last question on this before we get to kind of some ideas and some of the areas that you're really focused on. What about to the downside? You have these 40 checks, you know what I mean? Are you constantly reevaluating these sorts of things that you got you into the story? And then how do you think about cutting risk?
Yeah, 100%. So yes, if any of those things reverse, I sell the stock.
Yeah.
If I don't think I'm going to get additional 100 basis point return, I will probably going to get out of the stock. If I find something else that's more attractive, I will probably get out because there is an opportunity cost. Every name that you're owning, you have a 3% opportunity cost theoretically, right? And then, obviously we are a long short equity fund. So we also short, it could be market. We use derivative trades, a lot of, that's why,
you and I have talked about some of them. You seem to have, a lot of, I just found this over the years, portfolio managers, they kind of stick to the analysis. They stick to portfolio construction. Risk management's a big part of that. You do all that well. You just described all of that. But you also have this added knowledge of using derivatives to kind of express views in the markets, probably to add some, leverage or risk management or yield, that sort of thing.
Yeah, is a perfect example. It's like if a stock that you like, it's a core position, but they're at a price that you think not a massive upside. So at least in a short term, but you want to own the stock in the long term, right? But there's a bunch of stock you own, like Google, right? Buying, selling Google was a terrible idea.
Yeah.
I took Mercado Libre public in 2007 as an analyst, was a $700 million.
Wow.
If I were really smart, I would have sold, quit my job and put $1 million, and I'd be.
This is a South American e-commerce
business. Today it's like what, $100 billion.
Yeah, it's a monster.
Yeah. So that's in 14 years.
Yeah.
17 years. So to me, it's like some names are so great. Like buying, selling, timing market is very difficult.
Yeah.
So one way to optimize is that if you think a stock is at a price that you don't think there's a ton of upside, but there's enough vol, you can sell call.
Yeah.
Or if you think, or if you think that there's a potential downside risk, you can buy a put.
Yeah.
To basically you can hold on to your core positions and derivative set and can.
We like risk reversals around here at Risk Reversal Media, by the way. And so you just described you can collar stock that you own. You can, look to kind of do risk reversals, bullish risk reversals, sell, put, buy, call, all that sort of stuff. You seem to have a great handle on that. I want to talk about this for a second here. So in the last 10 years, you've seen this evolution of long only funds get into this crossover sort of business, right? So, let's say these big mutual fund companies, Fidelity and Wellington, they used to be the buyer on IPOs. They used to be the buyer on secondaries, but now they're getting exposure in these growth rounds as private companies are going to find their way into the public markets. So a lot of hedge funds also are doing this, right? So they're setting up these, separate funds and that sort of thing. And the idea is like, well, if you have this domain expertise, you might as well look to find companies in the private markets that you can express views on a bit earlier than we get to public markets. How do you think about that strategy?
I think it's a mistake.
Okay.
I think people made grave mistakes by doing so. One of my biggest proud moment is I did not invest any client money in private in last 5-6 years. Our fund doesn't invest in private. I didn't set up a private vehicle to invest, clients' money in private technology companies. And I think it's a grave mistakes that a lot of these investors made, and some really, really smart people made that mistake. My personal view, the story has not been told yet. We will see permanent capital loss from private that happened in last 5 years, a large number of permanent capital loss. Yeah. And I'll tell you why. There's a multiple reasons, and we can spend an hour talking about
of
that.
Course.
So number one, I think the skill set is different. I think what makes you a great public market investor doesn't make you a good private market investor. Private market investment is like banking. It requires personal relationship. You got to get to know these people. You got to build a true relationship.
You're betting on the founder.
You're betting with the founders, and to do that, the amount of time requires, you are away from your book.
Yeah.
So then you are not doing your day job. And if I'm not doing my day job, I'm not gonna be serving for my client. So So then how do they do that? Then they hire a bunch of people, and send them. The reality is, if you are a good private market investor or a public market good private market investors, and even if you're a good public market investors, this is not something you find out. You hire a good employee, you find out an employee is a good or not in 6 months.
Yeah.
But if you're a good investor or not, in a public market, you'd have to go through a downturn to know if you're really good, if you're really generating alpha, or you're just playing beta, which is probably a couple of years. In a private market, you don't know an investor is a good or bad for 5, 10, now this 15 years. So you take that, you hire a bunch of people, you don't know if they're good or not. You see the second problem.
Right.
Third problem is these companies are staying long private.
I was going to go there next, because it used to be 7-ish years that you would expect.
Now it's 10, 15 years.
Yeah.
But so even if you're a late stage growth, you're waiting long time, you don't know if they made good investment or not. But the next challenge is you raise so much capital. Like some of these funds, their private book is bigger than their public fund. So you have a bunch of people who has no track record, or very limited track record. And now they're deploying significant amount of capital. That's a recipe for disaster to begin with.
Right.
And now take that, why everybody I remember Yuri Milner kind of championed these things, that companies should stay longer, private longer, when he left. Yuri Milner was a founder and CEO of this company, DST Global, Mail.ru. Mail.ru was a social media company in Russia. He took this company public. I was an IPO analyst on this company. And after the IPO, he sold the stock. He created DST Global. And I remember talking to Yuri early days. He said, look at how much Amazon went public and how much value they created in public market, Google, and all these companies. If the company stays longer private, I will split the difference with the founders.
Right.
But the problem with any good ideas, everybody showed up.
Right.
And now companies are staying private longer and longer. Challenge 2, the private companies staying longer, 2 really big problem. Number 1, technology cycle change every 15 years. So what's super cool today is not going to be super cool 15 years from now. So now you're investing in a private company at a high multiple because it's now super cool. 15 years from now, it's not super cool. Your multiple compressed dramatically. So even if the company's revenue goes up big time, you don't generate return.
Right.
Problem number 1. Problem number 2 is executing for year after year after year. There's only a handful of CEOs have pulled that off. So when you go spend that kind of money and giving it to a founder and a CEO and hoping that they're going to execute for 10, 15 years in a row, the odd is against you. The odd is completely against you. Look at public market. How many companies have done it year after year after year? You can not that many, 1%, 2%, whatever the right number is. It's not 30%.
Right.
So the reality is, and the challenge with the private market is you only buy when the founders want to sell, and any smart founders sell at the peak. So all the odds are against you.
Yeah.
So that's why I think it's really, really tough to invest in private. And I think the market is messed up. This market needs to clean. It's getting better, but still not there yet.
Yeah, to your point, I mean, there was so much money raised at the end of 21 into 2022, and it's just it's either sitting there or, the capital calls are not coming in.
Or even in AI now, right? Listen.
All right, I want to talk about that. Okay, so to your point, 2 things. Stripe is a good example of the first one. Now, this is a company that everyone is in love with the management. The model has been great. Every e-commerce company and all this other stuff, they're all using their products, but they don't have any urgency to go public. And do you think that's a potential problem, though? They have access to capital markets in the privates. They can raise debt, they can raise equity, that sort of thing. But is that kind of an issue, ultimately, for them or
Listen, for them, it's fine.
Yeah.
If I were them, I would do that too.
Right.
But the reality is, if you're an investor, you are the,
You're
can
stuck.
I use the word the sucker?
Yeah, of course.
Because the reality is, one of my biggest pet peeves is that it drives me nuts. The investment is very simple. I take my financial risk, you take your career risk, and we split the difference.
I like that.
But now it's becoming, I take the financial risk and you get all the upside. That's kind of bullshit.
Yeah.
Right? The reality is, I recently got, somebody wants me to put a seed investment, like a convertible, it's just an idea, and the convertible that they want to raise only going to give me, if I take the whole thing, 2% of the company.
Right.
I'm like, seriously? like, it's like, but this kind of shit is happening, right? Like that is just like, listen, I don't think I have a fiduciary responsibility to my client, and I'm a big investor in my own fund. To me, it's like I will take a risk. Risk has to be we're both taking the risk,
Right.
And it cannot be like, oh, it's my job. The biggest problem with investment is like I recently tweeted about it, and then a bunch of people disagreed with me, a bunch of VCs, and I'm like, you guys are not investors. You guys are Hollywood agent. That's how the Hollywood agent works. The Hollywood agents, they, I had a bunch of friends who were, I'm not going to say names. They are very, very senior executive or was senior executive in a bunch of media companies.
Right.
And they just kiss up to the talent because talent makes great movies.
Yeah.
But the reality that's why so many media companies such a shit investment.
Yeah.
Because the thing is that what is your goal? Your goal is to, okay, I'm going to help people create great businesses. Fine. But you're not going to generate a lot of times by doing great return for your investors or for yourself.
Right.
Because if the risks are not aligned,
All right, let's talk about one other name that's become really big in a very short period of time. So OpenAI has raised about $6.5 billion. I think the last round was at $157 billion. How does a company like that ever grow into that valuation? Like, to me, so let's just say right now, I mean, the
reality is, not to interrupt you, even if it does grow into its valuation, it's a shit investment.
Yeah. Well, that's kind of but that's what I'm getting to. And why is so much money being thrown? It's Anthropic is at 40 billion. It goes on.
Like the biggest, my biggest problem. Okay, listen, I like to think I'm young, but I've been around on doing it for a while now. Early days of investment in private, you'd get a discount to public market, then become the discount parity.
Right.
Now you're paying a premium to be a private market. And you know what the biggest problem is? This is actually a fundamental problem in the market. And I blame investors for that. There is a massive risk adverse on volatility. Everybody wants to avoid volatility. And so how do you avoid volatility? As a result, we saw massive growth on market neutral fund in a public market. Everybody wants to do market neutral fund. Like it's crazy. Like
you have to be a crazy good stock picker on both longs and shorts to actually
listen, the
add
performance.
alpha
But
there.
at some point, like I always believe there's a good idea, and then everybody pile up on that good idea, and then good idea becomes a terrible idea.
Right.
So listen, I'm not smart enough. People call me emerging hedge fund manager, so I should not sit here and make a bold statement. But to me, when everybody tells me that they want to do market neutral hedge fund, I'm like, okay, when that story going to end?
Right.
And I don't know. Maybe I don't know something, but that's fine. But if everybody does market neutral, feels like it should not work. I'm just using common sense. There's no scientific. But the same thing happened on private. People wanted to avoid volatility. So they're like, okay, I'll put money on private, so there's no volatility. But as I said, if OpenAI even become a $300 billion in 7 years, it's a shit investment. Right?
Yeah.
Because you're getting 10% return, which NASDAQ actually, if you look at it historically, last decade did better in an illiquid asset. So you're really optimizing for volatility. Okay,
Yeah.
but that's what you're lining up for. But look at in 10 years how much execution risk you're taking, right? How much, like every time, if OpenAI was a public company, every time Google will launch a product or Meta would come out with a product, stock would be down 20%.
Right.
And here, your valuation only just go up, right? So again, I have nothing against OpenAI. I think it's a perfectly fine company.
Yeah.
But the reality is, even if they grow into this valuation, even if they surpass the valuation, the other thing people don't take into consideration, and I told that to media, they always talk about it in the terms of market cap. Nobody bakes into the dilution. Like the amount of dilution some of these private companies are taking is ridiculous. They just give out stock like without any corporate governance whatsoever. So the dilution is incredible. So even like there's not a single private company that I am aware of. I'm sure there's out there that taking less than 5% stock dilution. So if you take 5 years, 5%, that becomes 30% dilution just there.
Right.
So if you invest in a company today at X valuation, it has to be X plus 30% higher to at least break even. So that's why I'm like, I'm so glad I didn't do any private out of my fund and not plan to. And I get so much shit for that from early days. They're like, well, why don't you do private?
Well, it sounds like you're doing enough work where you're understanding what disruption is coming down the pipe from the private.
But I do
names.
it for my public.
Yeah, of course. All right. So let's shift to public markets here. And obviously, heading into 2023, this is right after, ChatGPT was launched in I think, what is it, ChatGPT 3 in late 22. And, it's funny, like there was no big theme driving technology before that came out, right? It was just kind of like, where is AWS going to bottom out? It was about market share among Azure, and those are the big names that were driving it. And Tesla was obviously about autonomy and full self-driving and all that sort of stuff. But there weren't that many exciting things going on in mega cap tech, right? And at the time, at that time. So then all of a sudden, if you look at the excitement in and around these large language models and what they were going to do, that not just being bolted onto some of these big clouds, but how different companies were going to use them to kind of gain productivity for their clients, that sort of thing. All right, so let's talk about, at first, it was NVIDIA, right? And so Microsoft had already made that investment into OpenAI. NVIDIA was supplying the chips to OpenAI, and then all the other hyperscalers that were kind of building out. So you have Google, you have Microsoft, obviously. Amazon was getting into the game. And so when you think about that sort of investment that was happening, it was very narrow at the time. Would you agree? And then people started working down. All right, well, servers need to go in the data centers, and the chips, we already had the NVIDIA, but then they needed memory, right? And so when you think about like the excitement seems to be waning in some areas around the chip market. Like you saw ASML's guidance for their bookings about a month ago. Micron's guidance wasn't particularly great. Supermicro has blown up, a competitor to Dell. Dell is a low margin business, right? And a lot of those stocks have come in pretty hard. It's just NVIDIA right now. And, Microsoft hasn't made a new high as the market's made new highs. So there's a lot of stories that don't look that interesting. Apple was playing catch up. Apple Intelligence is a total joke right now, right? So talk to me how you're thinking about this, what's played out in the public markets after nearly 2 years of the introduction of ChatGPT.
Yes, I'll go to that. But I want to point out one thing.
Yeah.
Going back to
no, it's okay.
that. If you look at last 2 decades, three of the most exciting things came out of public market.
Yeah.
Cloud, AWS, Google Cloud, Azure, all public companies. iPhone, public company. But you saw, or self-driving cars, things like that, automation. So I think a lot of these things coming out of the public market. So public market is actually doing a pretty good job. But going back to your question, I do want to answer your question. So I think you're right. I think I look at the AI opportunity set in few buckets. So number one was the chips. And NVIDIA seems like significantly ahead of everybody on that. The second is, companies that are providing specialized products on the data center, like Astria Lab, Lab, ticker, has done really, really well. Revenue was up 46% quarter over quarter.
And that was an IPO last year. Is that right?
Yeah. Has done. Again, I don't know how it's going to play out, but it's something. Last quarter, I think their revenue was up 40% quarter over quarter. Which is pretty amazing, the things that they're building.
And again, this is off a low base, but these are the sorts of opportunities you're looking for. This is a company that did, $300 million, or expect to do $300 million in sales this year, $600 next year, and then $850. Yeah,
if you're going to build that kind of massive data center build out, there'll be a lot of components and small companies that will participate on that, right? And we got to find those companies. So that's the second bucket of the companies. The third areas of I'm looking at companies that will use AI to deploy software and services that consumers are willing to pay for it, or the businesses are willing to pay for it. I think the biggest thing we need to be careful on that is that everybody will be building AI product and services using AI. I think there'll be winners and losers. So the winners going to build product that people are willing to pay more. So your margins will be better. You're going to be able to garner more. The losers will be, they're going to build a product that people are not going to willing to pay more, but they're going to take on the cost of AI.
And would you throw like these large language models into that? Like they seem to be headed to be really commoditized, right? So you've seen this massive investment to kind of create the ability to kind of train the models, right? And then, the inference phase. And it just seems like from a consumer standpoint, they've been conditioned to get free search, right? For the most part. So the idea of paying $20 a month for consumers, it's not scalable, right? Nope. Like, so, and then are you focused more on consumer applications or enterprise applications?
Both.
Okay, both.
Both, but some enterprise software also, the businesses will demand it for free, right? Because, I'm not going to pay more for XYZ services, because you put ChatGPT. If you don't do it, if you don't offer the same price, somebody else will offer at the same price. And
is that why then enterprise software has lagged so dramatically? If you were to look at Salesforce until recently, and if you were to look at Salesforce, Adobe, Workday, these are companies that had been left behind in this whole thing. They've just recently started to rally.
I think there's two things happen on software. Number one, the estimates were too high for this year, in my opinion. So if you look at a lot of these companies didn't really beat the numbers that much, So those estimates were, so there was very limited opportunity for beat and raise.
Yeah.
So when there was no beat and raise and the valuation is already priced in,
right,
you couldn't do anything with this.
But couldn't you make the argument right now that that's the situation with Microsoft, Google, Amazon, Apple? Like the forward numbers aren't going up. The beats are getting smaller and smaller.
And the stocks are not necessarily cheap.
And Meta, we can kind of throw in that category. And then their CapEx has kind of, continues to
grow.
Stay put, and growing. And so they're going to kind of ask for forgiveness rather than permission on the build out. Does that make you a little nervous about some of the mega cap tech stocks?
100%. Yeah, 100%. I think, if you look at the mega cap, you look at their long-term opportunity, makes me very, very excited.
Really?
Yeah. Like, I think Meta or Google or, obviously they have a lot of competition, but what they have is massive installed base and massive know-how and massive financial capital. So unless they screw it up, they should be able to do well. Now, so that excites me. But if you look at in a near term, there are some headwinds, right? Number one, their CapEx is going up, so the free cash flow is not growing. Business for the first time has competition, right? So they have to win these battles. They're not, I think they're advantageous position, but, people with advantageous position also lose. So you cannot take things for granted. So they have to, right? You are seeing paradigm shift, right? It's a new kind of things, but they have more competition. I always look things incrementally. Is things getting incrementally better? Incrementally, I think you can argue that they have more competition than they had before, and so all those things we need to, and some of these companies also have culture problem, that for the first time they actually have to work hard, so all these things you take into consideration, there are risks. So, but that's, to me, is like, at a minimum, when people say that business has no risk, it scares me.
Yeah.
So now, at least everything I just told you, I'm not telling you something that nobody knows. So I actually feel like some of the risk people are aware of. And but I think we got to pay close attention to it.
All right. And again, you just said a little bit ago, you don't care about market cap. You have Apple, NVIDIA, Microsoft. They're all like $3.5 trillion in market cap. Then you have Google, Amazon, both about $2 and change trillion in market cap. Then you have Meta and Tesla that are both, I don't know, one, and that sort of thing. Do those companies that, again, have massive install base, we'll leave Tesla out of that, but the first, kind of six that I mentioned, and there's such a the concentration in them, in the indices, and then the crowdedness of them among investors, does that make you a little nervous? Because again, I go back to kind of 2022, we're in that sort of bear market. The NASDAQ was down about 30% or so from the highs. It was very orderly. It did, but despite the orderly nature of the sell-off, Meta, Tesla, NVIDIA, and Netflix were all down about 70%. These were darlings, right, of the bull market in 2020 and 2021. And so I think people have kind of very short memories that sort of, drawdown can happen in individual names. So I'm just curious, do you think that there's some danger to the size of these companies' market caps, the valuations to some degree, the crowdedness in them among investors?
Yeah, 100%. There is risk. Listen, I think as a portfolio manager, I recognize all of those risks and I have to be careful. The biggest lesson I learned as a portfolio manager, never fall in love with the stock.
Right.
At the end of the day, they are stuck. And so there is risk. And I think there is real risk with indices for sure, right? Because not all 6 has to do bad. If 1 or 2 of them do bad,
right.
Down 20, 30%,
Right.
that'll be a big drag on index.
Well,
right?
think about this. I mean, Tesla, the announcement of it going into the S&P 500 in late 2020, the stock was trading at like, I don't know, $200. It topped out at $400, like literally less than a year later. And, last month it was trading at $200 again. That's a drag on the S&P performance. All right, let's talk about one last thing before we get out of here. So I find your process fascinating. I find your history of tech cycles fascinating, your risk management and the process in which you kind of get into positions and the long-term nature of the macro view, all really fascinating stuff. Last month, I mentioned this conference, that you held. It was invite only. It was like a home run. It was like, forget about who was on stage for a second, but the people there, like some of the most interesting public market investors, private market investors, bankers, founders. I mean, it just went on. And then on stage, you had Joe Chai, which you just mentioned, from Alibaba. You had Evan Spiegel. There was a handful. There was a panel with folks from Google Cloud, from OpenAI, talking about these stuff. Like, how are you using that experience to kind of build out your brand? You brought everyone down to Dallas, which is where you are right now. It was just a great event, and we all get so sick of a lot of these big industry events. And it was really one of those things where people could network, they could get to know the speakers, the fellow investors or bankers, that sort of thing. Talk to me a little bit how that came about. That was the second year you did it, right?
So that came about. So that has nothing to do with my fund.
Yeah.
So that came about, when I moved to Dallas, I was really concerned that I'll lose my friends in East Coast and West Coast, and I was like, what can I do to keep in touch with people?
Yeah.
And I'm at an age, I have young kids. I'm not so young anymore, 15 and 11, and I don't want to travel all the time to go see people. I said, and I didn't want to throw a birthday party or, or some Christmas party.
Yeah.
I'm like, what, we should do a leadership summit, and try to get everybody to come to Dallas. So it's really a way for me to bring, I've been blessed with friends from my research days, the people when I was an analyst, the people who grew up with me are now the portfolio managers of some of the biggest funds, because we just grew older, and they move up. And, my old boss used to say, sometimes you move up in life by staying in one place, and then when I was a banker, I met a lot of fascinating people. When I was an operator, I met a lot of fascinating people. I was like, okay, how can I bring all these people together? As you pointed out, there's investors, there's reporters, there's policymakers, there were
there were a couple senators.
There were a couple of senators.
Yeah.
I was like, all these people I became friends over the times.
Yeah.
How do I bring them together and introduce them to each other?
Yeah.
And just have discussions about leadership, economy, and things like that. And that's my way of bringing all my friends together. And because I don't like having birthday and things like that. So it's a good way to do it. So that's what I do.
Well, you did an amazing job. You interviewed a lot of these folks on stage. And I think, aside from those great conversations, it was an amazing networking sort of opportunity. So I know a lot of people who really appreciate it. By the way, that my wife is from Dallas, and it was fascinating. I don't know if I told you this.
Yeah, you did tell me.
But so the dinner to kick the thing off was where I had my rehearsal dinner, and then the hotel, and in the room, that this conference went on, is where I got married. So it was kind of a really fun experience for me to do that. So listen, I enjoyed this conversation. Your process is fascinating. I think that's really a lot of our listeners, we get these questions all the time. How do you come up with ideas? How do you risk manage ideas? How do you put together a portfolio? All that sort of stuff. That was a master class in doing that, Imran.
I appreciate that.
I really appreciate you coming here. Let's do this again really soon. And I'd love to dig into some names that you're involved in, because I know that, again, I think you're thinking about things not in the here and now, but you're thinking out a year or two, that sort of thing, even longer, by the way. So I really appreciate you being here.
Thank you for having me. It's good to see you again.